Right as I'm recording this video, over 130 countries, representing 98% of global GDP, are building digital currencies. The digital yuan in China has now surpassed $986 billion in transactions. India's e-rupee has surged over 330% in just a year. The IMF released a November 2025 policy paper detailing exactly how central banks intend to execute what they're calling a financial reset. This isn't speculation, conspiracy, or theory. This is infrastructure being quietly implemented while most of the world scrolls through social media. And here's the reality. If you don't understand what's coming in the next 12-18 months, you risk being on the wrong side of the largest wealth transfer in human history. Your government is currently running a policy called financial repression. That's a term economists use for the quiet, systematic transfer of wealth from citizens to the state. Interest rates today sit at around 4%, while inflation runs near 6%. That means roughly 2% of your purchasing power disappears every year. That's not a mistake. That's deliberate policy. Look at history. After World War II, the United States reduced national debt from 106% of GDP to 23% in just 28 years. They didn't pay it off. They inflated it away. Wealth was transferred from savers to borrowers, from citizens to the state. The UK followed the exact same strategy, dropping debt from 216% to 138% of GDP in a decade. Now, global debt sits at over $100 trillion, or 93% of GDP. What makes you think they won't do it again? Only this time the scale is 10 times larger. Financial repression has always had a flaw. People could escape. You could move money offshore, buy Bitcoin, hold physical gold, or invest in foreign assets. As long as cash exists, you have an exit. But that is exactly what CBDCs, central bank digital currencies, are designed to fix. CBDCs aren't just digital dollars. They are programmable money, money that can expire if you don't spend it, track every transaction, and even be turned off entirely. The European Central Bank openly calls their plan a global euro moment to strengthen currency control. China is already running cross-border CBDC transactions between Hong Kong and the mainland. This is not a pilot program. This is full-scale deployment. If you think this doesn't affect you, let me be blunt. If you hold cash, bonds, CDs, or any fixed income assets, you are the target. The system is designed to extract value from exactly these positions. For example, if your retirement account earns 5%, but inflation is 7%, you're effectively losing money every year. That's not bad luck, that's policy. When politicians discuss wealth taxes, unrealized gains taxes, or property taxes, they're signaling something important. They're looking to extract value from any measurable asset they can find. The reason they haven't done it fully yet is they lack visibility into your financial life. CBDCs will change that overnight. Once fully deployed, every transaction, every account, and every asset you hold will be visible and programmable. Why the wealthy are always ahead? The wealthy aren't panicking. You know why? Because they don't hold cash. Ultra-high net worth individuals typically keep 6 months of expenses liquid, while the rest is held in assets that can't be debased by inflation. Real estate, businesses, commodities, gold, Bitcoin. These are all inflation-resistant assets. When governments inflate the currency, these assets rise in nominal value. A $500,000 property doesn't become more valuable because the land changed. It becomes more expensive because the dollar is worth less. Essentially, the wealthy hold the ruler, while the average citizen holds the thing being measured. Sovereign wealth funds are already taking action. The Abu Dhabi Investment Council tripled their Bitcoin position in Q3, taking it to $520 million. MicroStrategy buys every dip. JP Morgan is accumulating quietly. These aren't panic moves by retail traders. These are the people who move markets, and they're positioning ahead of the rest. Lessons from history. When the Great Depression hit, the people who depended entirely on wages and city life suffered the most. But rural families, farmers, and those who were self-reliant survived. For example, Helen Bolton worked on a farm in Nebraska. Her daughter never went hungry because they had chickens, canned meat, milk, and bread. Urban families splitting a single meatball between 8 people were starving. The difference wasn't location. It was self-reliance versus system dependence. The Depression-era motto was simple: use it up, wear it out, make do, or do without. Families resoled shoes patched with cardboard, canned tumbleweeds, and replaced toilet paper with rags. Extreme. Yes, but that's what happens when currency collapses and supply chains break. Fast forward to 2008, and survival tactics had changed. Millennials often avoided the job market, flooding graduate schools and community colleges to wait out the storm while taking on debt. This worked only because the system still functioned. Loans were available, schools were open, infrastructure held. What happens when the financial reset hits and those safety nets vanish? The Federal Reserve is currently trapped. Inflation is elevated. Economic growth is slowing. They need to cut rates to stimulate growth, but they're afraid of inflation surging again. The recent government shutdown created a massive data blackout, leaving policymakers essentially blind. Interest rate decisions are being made without accurate information. FedWatch currently shows only a 48.9% chance of a rate cut in December, down from 90% weeks ago. In times like this, risk assets get crushed first. Whether intentional or not, the result is the same. Retail investors are flushed out, liquidity dries up, and institutional investors accumulate at lower prices. Bitcoin, for example, could test $76,000 or lower if the Fed doesn't act and economic data disappoints. What modern survival looks like. In the Depression, survival was about skills: plumbing, carpentry, gardening, raising chickens. A jack of all trades could find work. Today, that translates into digital skills, remote work capabilities, and multiple income streams. You can't rely on one paycheck from one employer. Social networks were crucial in the Depression. Families lived with extended relatives, and communities helped each other with food, money, and labor. Today, that means building your own network, communities tracking economic trends, sharing information, and acting as an early warning system. Assets that protect you share 3 key characteristics. Intrinsic value independent of government decree. Limited supply. Difficult to confiscate or devalue directly. Examples today. Bitcoin. Supply capped at 21 million. Gold. Annual supply growth of 1–2%. Productive real estate. Generates income and appreciates. Shares in businesses controlling real assets. Defensive, non-speculative. When money supply grows faster than economic output, nominal prices rise. You want things rising in value, not cash declining. Emergency funds belong in high-yield savings, but beyond that, cash is a wasting asset. Bonds are loans repaid in devalued currency, a guaranteed loss if inflation exceeds yield. Practical steps to protect wealth. Diversify geographically, foreign bank accounts, second citizenship, international brokerage access. Hold inflation-protected assets, tips, real estate, commodities, gold, Bitcoin. Develop skills, digital, technical, and practical. Create multiple income streams, side businesses, freelance, digital products. Strengthen networks, family, friends, community connections. The ultra-wealthy also use structures like family offices, trusts, and separately managed accounts to manage taxes, estate planning, and global assets. Donor-advised funds allow charitable contributions now, while distributing grants over time. These aren't secrets, they're just knowledge most people don't access. The mental edge. Financial survival isn't only about strategy, it's about mental resilience. Depression survivors learned patience, persistence, faith, creative problem solving, and humor. Laugh in the face of adversity, and it loses power over you. Now, you have a window of opportunity. You can still move assets, buy real estate, gold, Bitcoin, open foreign accounts, establish residency abroad, and position defensively. This window is closing fast. Every quarter, support the channel, subscribe, and give it a thumbs up.